What's up, YouTube?
What is going on, everybody? Thank you for joining us on our Sunday live stream today. It is
an unofficial first day of spring,
March
as declared
7th.
by the City Mortgage Team.
Yeah, it is absolutely gorgeous outside right now.
Yeah, a really nice day. It's cold, wear a tube, but still sunny and nice.
It was decently chilly out, but it is nice. Pop your thing a little bit so we can take a look at our people. What's going on, everybody? How are all of you this fine Sunday? I don't know if any of you have watched our video that dropped, or Scott's video that dropped last week. Can you please explain first home buyers? Sure, I guess.
Questions right out the beginning.
Yeah, look at that. Yeah, so sure. While we're getting everybody in here and we're prepping for our actual content, we'll talk about first-time home buyers. So first-time home buyers, you're in a little bit of a unique situation. So the government actually gives you a handful of different tools to be able to access when purchasing property. You have the ability to draw $35,000 from your Rrsps to use as a down payment. This obviously has to be paid back over a certain period of time, but you can use them as down payment. The government also gives you $4,000 towards your land transfer tax credit when you purchase a property. This isn't something that has to be paid up front or it's rebated. It's something that's actually taken care of at the lawyer's office right away, which is super advantageous. And you don't need to be a first-time home buyer, but it is good to note that you can get an insured mortgage when you purchase a home for as little as 5% down. If your house price is under $500,000, it's 5%. If it's over $500,000, it's 10% to $1 million. Anything over $1 million can't be insured, unfortunately. Single-family home and duplexes are 5% down. Triplexes and fourplexes are 10% down. Any rental property, 20% down. As a first-time home buyer, there's a handful of ways to be able to house hack to get in. So, if you're looking to use a little bit of rent to be able to help with your qualification, maybe boost that up a little bit, you can do that. There's a handful of options available to you. The government does have a share equity plan where the government will take a portion of your down payment and essentially own a portion of your house. They can help with that situation. So there's a handful of different products and solutions available to you if you're a first-time home buyer looking to get into the market.
Yeah, it's important to note that even with that assisted down payment product, you still do have to qualify for it personally. So just because you're getting a bit of subsidy from the government, you still have to qualify as if you were putting the money down yourself. So you're really limited to like 4 to 4.5 times your income. I think it is. They might have changed it a little bit, but you still do have to personally qualify for it. So just keep that in mind when you're asking about that product and looking to qualify with the first-time home buyer program.
For sure. Yeah, I think today we're actually going to get into, so if you didn't watch our video previously last week, Scott, one of our business partners, dropped a video with Matt, and he was talking about NOI and cap rate. So for anybody who doesn't know, cap rate is essentially used to value commercial property. And we kind of get into how that works, how you can use it, how you can calculate what your ARV value is based off of an estimated cap rate, and why it's important to use. So I guess we'll just kind of jump right in and get started. As always, if you have any questions, please feel free to drop them in the chat below here, or if you're on YouTube, that side. We're always happy to answer any questions you guys might have.
Yeah, cap rate is something to keep in mind right now, and during a hot market, especially when you're looking at purchasing the multi-unit residential buildings. Basically, a cap rate is a good indicator in how much you're able to appreciate the property itself. Right now with the hot market, some of the investors that we've talked to, we've seen cap rates in Toronto somewhere around the 1 to 2.5, like almost 3% area. Kitchener, Waterloo, Guelph, Cambridge area, 3 to 5%. Hamilton, St. Catharines area, you're 5 to 6.5%. So, with that hotter market, we're starting to see lower cap rates or like a more aggressive type cap rate in the marketplace. And the big thing that it kind of brings to point and makes investors look at is for those who are looking to burr a property and get in and force appreciate it, basically how much room is there really left in that property to be able to increase that value and be able to pull that equity afterwards. If you're looking at Toronto properties on the multi-unit side and they're at a 1 to 2 cap rate, and you're buying in the KWC Guelph market at a 3 to 4 cap rate, what are you really needing to see from other properties and the market in general for your property to just appreciate naturally? If you're looking at getting into a property at a 3 or 4% cap rate, you're essentially looking at Toronto cap rate being close to almost zero, right? As that market starts to appreciate up and the property value goes up. So just learning how the market dictates your cap rates and what type of things you would need to see in that market for your property to be affected. When you're starting to buy at these these lower cap rates, there's a little bit less room in the property value for you to be able to go in, force appreciate it, have the market appreciate it, and to be able to pull out those returns. So for some of these properties, you're looking more at a cash flow perspective versus the ability to get in there, do some renovations, actually pull out that capital. So just kind of keep that in mind and again, understanding how to look at the market and read the caps and what that might mean for your project.
Yeah, no, 100%. Yeah, relying on forced appreciation over time might not be obviously the most advantageous thing that you're looking to do when you're purchasing multifamily property. But depending on what the cap rate is, you might actually benefit from that, especially in a market like this. We're seeing, honestly, properties in Toronto going for a 1 cap rate. At the end of the day, unless obviously you're just like a REIT or someone who's purchasing based off of jamming into Cmhc and taking cash flow on a property, that makes sense. But a lot of these valuations are causing a lot of issues for our multifamily investors who necessarily maybe could have purchased a property a year ago, but can no longer purchase a property because the amount of cash needed up front to be able to get these debt servicings in line now, because the value is appreciated so much, you're always under rented. Mm-hmm. You're never going to have enough rent, or at least currently right now, you're never gonna have enough rent at the moment to be able to cover that 1.2 DSR to the point where your down payment actually makes sense anymore. Yeah. I got the majority of my clients are now relying on $700,000 to $1 million in down payments to be able to get into a property conventionally to make the debt servicing work. So one of the cons of this market is really the hysteria around valuations in multifamily properties has raised it to a point where it's kind of limiting the people who are looking to get into that multifamily market. Mm-hmm. Because everything's under rented at the moment. Yeah. It's difficult.
Yeah. And the big thing right now on the multi-unit side is, the inability to get tenants out. There is that rent, the eviction freeze. So, you're supposed to be more restricted on getting tenants out. I have heard stories of investors being able to get tenants out, but, it's a completely different topic. As per just the bylaws and the regulations, there is supposed to be an eviction freeze. So, like Josh said, purchasing these off-market properties, especially at a higher valuation, and owners are looking at the hot market, thinking their properties are worth a lot more than what they might have been last year or 2 months ago. These higher market valuation prices with these lower rents, the majority of properties that investors are picking up because they're off-market, they're slightly under-rented. Or they're looking at an under-rented property as it is because of that ability to go in there and increase the cash flow. If you're going to have difficulties getting the tenants out and turning over those tenants and increasing that cash flow, you're looking at a private mortgage solution or some sort of repositioning phase type mortgage where you're looking at a 35% down payment and potentially some sort of interest only type product. A 35% down payment takes a $180,000 to $200,000 down payment to a $380,000, $400,000, and we're even seeing some $500,000 down payments. And at that point, it becomes a real numbers game. Is it worth the amount of capital that you have to put into this property just on the down payment, plus any renovations that you want to get done to attract a higher rent payment for the tenant? Some of the investors out there who like to utilize a cash for keys type asset or acquisition model, how much more are you willing to pay on top of that plus your down payment, right? So just keep these kind of things in mind, and it's not to deter anybody, but it just means your numbers have to be much more on point. The ARVs have to be on point, especially if you're getting in on a private solution. We need to have that strong exit strategy to be able to get out of that private option. It really just comes down to the numbers, and like I said, making sure they're tight and you've taken in all considerations.
Yeah, for sure. I mean, I think looking into the future and what's going to happen is you're going to see more private capital entering the market as values increase and the barrier to enter the market gets lifted. I think you're going to see a lot of private capital or like flexible solutions enter the market to help people get into these transitional properties or within this transition phase. And this transition phase is really interesting because the market doesn't have a whole lot of solutions for it. No. And it's one thing we want to tell you guys is that when you're looking at an undervalued property, like what's your strategy here? Because there are essentially only a handful of options. You either service or you don't service. And if you don't service, are you willing to pay the fees on acquisition and be able to get into that solution? So, we have there's obviously different capital firms and mortgage investment corporations and other things that allow you to get into these properties, but they're quite literally is you either debt service or you don't. And the ones that have more flexible solutions on the B side, they have requirements to transition you to CMHC. So if you were to buy an under like servicing property, they would want to help you to bump that amortization out and get you into that acquisition at 1.1 DSR. They need you to be able to transition into CMHC. That's their exit strategy. There is no like flipping it and selling it. So, unless that's your exit strategy, it's really difficult to be able to help somebody who owns a multifamily property that's underperforming without getting into some sort of private solution. So I think that part of our industry is going to grow as you see values increase and rent not increase as much.
I have a question here on YouTube from Josh Norris, and the question is, so do we want to buy with a low cap rate or a high cap rate? And it basically comes down to this. A lower cap rate means it's a more turnkey property, so there's less availability for you to go in, make forced appreciations, get those rent rates higher, and be able to turn that property over. When you're purchasing at a higher cap rate, it means there's more opportunity for you to go in, make changes, get the rents back up to max, closer to max levels on market levels, do some renovations to the property to be able to attract those higher rent payers, and then be able to force appreciate the property based off of a income producing appraisal, getting that higher valuation, and being able to take that equity pull out on the refinance. So, most of the buyers that we're working with and that we see on the investors are looking to buy on a more higher cap rate versus a lower cap rate. Like I said, the lower the cap rate, the more aggressive the numbers already are, the higher the rents are, the more turnkey it is. The higher the cap rate, the lower the rents are, the net operating income, the more room for the investor to go in, turn those rents over, and pull out that equity after a higher valuation.
Yeah, completely agree. It really just depends on the strategy you're looking to implement. If you are looking for something that just has really great cash flow and you don't have to do a whole lot of capital appreciation to be able to increase the value, and you just want a turnkey property, get a really low cap rate. It's gonna be a great asset for you long term, but you're not gonna take on that capital, that appreciation of the asset, and be able to pull cash out to be able to rinse and repeat what you're doing. Whereas the other option is force appreciate the asset and big burr it and rinse and repeat and do exactly what you're doing. So we usually see people who have a ton of capital buy lower cap rate products, whereas people who don't necessarily have unlimited amounts of capital to purchase property are buying higher cap rate products to be able to increase their cash position and buy more properties.
Mm-hmm. Yeah, there's two reasons why you would see a higher cap rate. Either the rents, on a fully tenanted building, the rents just aren't up to date. They're drastically under market levels, or there's some vacancies in that building. Obviously, right now, with those restrictions on evictions and being able to turn the tenants over, purchasing a vacant unit has the best option. There is no trouble for the renter or for the landlord to go in there and turn over those vacant units. You can go in, you can start renovations right away. You don't have to worry about, placing the tenant into another unit or being able to work around their schedule. You can go in there and get those renovations started from day one. And then, a much quicker turnaround time on increasing those rents as well too, and less hassle. You're not negotiating with a tenant trying to incremental increase. You have a wide open unit. You can go in there and you can turn those rents over right from day one and start the asking price, at where you want those rental incomes to come in. So paying attention to that and understanding how the net operating income affects the cap rate is going to help you evaluate your properties and take a look at, am I overpaying for this unit slightly? Hey, there's 2 or 3 vacancies on this, and this is what he's asking at. And these numbers they don't quite come out where I think they should be. Or, hey, this is a fully tenanted unit. I'm taking a look at this, and that, this is coming out at a 2% cap or a 3% cap. It's going to be a lot harder for me to go in there and turn a profit on this unless I do a ton of forced appreciation to it. So, just understanding, like I said, how that affects your ability to go in there and create a profit and pull out that equity a year or 2 later. It's going to be a deciding factor on which properties you want to put your offers in on, depending on what type of strategy you're looking for you're investing.
Yeah, for sure. And I think there's some cool strategies that our clients actually come up with. So one of the strategies I saw the other day that most people don't actually do is just individually metering things. Mm-hmm. So like once you take possession of a property, how we find the NOI or how we find your total DSCR, we have to minus off all the expenses. So one of the large expenses that a lot of people have when they purchase a property or an underperforming property is, they have to cover the utilities on a building. Mm-hmm. And those utilities can sometimes be astronomical, like 10, 15% of the overall expenses on a property. So what some people are doing is they're strategically finding buildings where they're going to be able to individually meter each unit and then go in, individually meter each unit, take that expense away and automatically increase your overall NOI and increase your DSCR. So there are a handful of really strategic things you can do to a building that are going to allow you to increase that overall qualification, which is something cool that I saw. Another one I think was the washers and dryers.
Yep. In-suite laundry.
Yeah, in-suite laundry is big. It adds a ton of value to your property over time.
Parking, on-site parking. The last thing a tenant wants to do is having to park on the street or park somewhere further down the road and having to walk. There's a few things actually. I talked to an appraiser a while back for a client of mine. He was looking to do it was a commercial building with some office space, and he wanted to go in and renovate it and turn it into residential units. And one of the things that the appraiser that I was talking to was talking about was, on these higher floor types, if it's a 5-floor or 6-floor type building, is there in-suite laundry? If there isn't, where is the laundry located? Is it on the main floor? If it's on the main floor, is there an elevator? Is there stairs? What type of restrictions or annoyances or nuisances are the tenant's going to have to face to be able to do their daily tasks? Does a tenant want to have to walk down 5 stories of stairs to be able to do their laundry back and forth every day, or whenever they do their laundry? No. Is there an elevator to help ease that? Yeah, absolutely. Okay, perfect. You're going to be able to ask for that higher rent. Is there in-suite laundry? Is the convenience even easier for the tenants? Perfect. Yep. Okay, then you're going to be able to ask for those higher rents. Is there on-site parking? Yep, perfect. Okay, those higher rents, basically just looking at the amenities and how they're going to be able to affect your rent. And, are you going to be able to get away with the top 10% percentile, or are you going to be looking at the 90% percentile of your market rent and looking at how those amenities are going to be able to affect your rental rates? Yeah,
so one of the things I also wanted to touch on was expenses. So if, for example, you're purchasing a property and that property has a very large expense last year that, you asked for the expense reports the last 3 years. Last year was way more than what it was the year before. And you go to them and you say, hey, what's going on? Why is it so much different than what we usually use? So we currently run our numbers at around 5% property management, 5% maintenance on a property. And that's what the kind of industry standard is for maintenance. So if you have something that's an outlier, such as a boiler or a roof or a large thing that needs to be fixed, we can actually make a case to our lenders to say that that's an outlier. That's something that's not consistent with the past year's history. So we might be able to actually maybe deduct it or at least find an average over a certain period of time to be able to use a lower amount and help qualify the loan. So just because last year had a outlier expense that wasn't consistent with the year before, it doesn't mean that you're going to be screwed when it comes to your overall DSCR on purchase. Just a bunch of cool things to consider. I know everyone's dealing with what you'd be able to using a holding corporation and adding back some of the amortization and stuff.
Yeah. So if you're purchasing a commercial property, doing a small business or a commercial loan, and the purchase is in a holding company, there's some things that the lenders are able to take a look at and add back to your operating income. So they're looking at amortization, any of the mortgages that you're amortizing and utilizing that and paying that off. That amortization is essentially just interest. They're able to add that back. Long-term interest as well too. Any type of loans your company may have that you're borrowing over time, that long-term interest they can add back. And then, like Josh said, any irregular expenses, a roof, paving the parking lot, stuff like that, where, maybe your average yearly expenses on the maintenance is $5,000, but this year you had $20,000. They're going to take a look at that, and they know that you don't need to replace a roof every year. You don't need to pave the parking lot. You don't need to paint the building every year. Those anomalies, they're able to add back onto your net operating income and create more cash flow for the operating company. So there's some things that they can take a look at and add back. And really the commercial side is just it's very fluid. We talk about debt service coverage ratio and wanting that 1.2, 1.25. But there are a lot of factors that the lenders will take a look at beyond that, depending on how close it is to that 1.2. If you're at 1.15 and you have a net a holding company that has this huge retained earnings, maybe they're making $1 million a year, you guys are able to retain $500,000 in the company per year. They're going to take that into consideration. They're going to look at that and say, hey, these guys are, walking away net $500,000 in their company every year. That more than makes up for this 0.05% DSCR that we're missing. We feel comfortable giving this loan, even though it's not at 1.2. Or in the reverse case, maybe you're at 1.15 and your holding company shows a deficit year over year. You're negative $60,000 each year. If you have no retained earnings in the company, the lender's going to take a look at, where are they able to pull these extra funds from to be able to hold on to the property and maintain it and deal with maintenance and management and repair costs? Are they going to have to service this debt personally and come up with this debt personally? Well, let's take a look at what their income is. If they're only making $60,000 a year and maybe they have a couple other properties in the holding company already, well, there just isn't enough money coming personally from the borrower to be able to service the other mortgages they have, plus the maintenance and mortgages that they're going to need on this purchase. So it is more fluid than just looking at a 1.2 to 1.25% DSCR. And the lenders do take that into consideration.
Yeah, like as I said before, it's more like a big picture that is being painted for a lender. Like it's not as easy as conventional financing where you check a bunch of boxes and you qualify for the loan. There's a handful of things that go into it, whether that's borrowing power, down payment requirements, equity position, cash reserves, the building itself, the location, the market. There's so many things go into it. So it's not something that is 100% specific on your situation. It might be something that completely has nothing to do with you in general. It might just have to do with the market conditions and the building and the location itself. So, there's a handful of things that go into it, and it's more like us just putting a puzzle together at the end of the day.
Yeah, and if you own more than one holding company, and the holding company that you're looking to purchase in has a deficit, but you have another holding company that has, a large retained earnings, you can offer a corporate guarantee. And basically, instead of personally guaranteeing, or in addition to your personal guarantee, you can have your other corporation guaranteeing the mortgage as well. Now they're able to look at that income coming in from the other holding company that may make up for the difference in the deficit that you have in your purchasing company, and the lender may be able to do the loan. There's lots of different strategies and things that we can take a look at to help restructure the loan and make sure that we can get it done conventionally.
Yeah. So when people also just touching on this, when people think of cap rate, obviously, when you take your NOI, you divide it by your value and your cap rate, but it's kind of backwards when it comes to appraisers. So appraisers actually use a generalized cap rate depending on risk in certain areas. So really interesting is the fact that commercial appraisals, a lot like residential appraisals, are just people's opinion of a value of a property. So at the end of the day, a commercial appraiser is going to use a cap rate that he thinks is consistent with a certain area and a certain type of property that you're looking to acquire. Now, that might be either a really good thing for you or a not so good thing. We've had clients who have had an appraiser who used a higher cap rate than they would have wanted, and so he didn't get the value that he wants. Now, obviously, having a conversation and being able to justify your position and why you think the cap rate is what it is. There are situations where you start to look at alternative appraisers. Like, at the end of the day, it is a opinion of somebody as to what your value is at the time. And I'm not saying go shop appraisers or go do those things, but at the end of the day, a cap rate is dictated by what a appraiser's perception of that asset is in a certain area. So just something to keep in mind, how they use cap rate and how you use cap rate are two very different ways. You use cap rate based off of NOI. They use cap rate based off of what they think the actual value of an asset is in an area, based off of like generalized consistency. Mm-hmm. So interesting, I guess, way of valuing property, because one is very accurate, one is a perception.
Yeah, I mean, the bottom line is that, no matter what you may have down on paper, the majority of the details for the approval comes from, the appraiser and the way they do their evaluation, the lender and how they do their evaluation on the property. And if you're looking for it at CMHC insured property, how does CMHC value the property? The algorithms and the calculations that CMHC uses are much different, and pretty often comes out with a slightly different value than what the property has even been appraised at. So depending on what factors are going into there and what type of product you're looking for, you might see a few different valuations given to the property.
Right on. Well, we had a question come in from YouTube. It says, "Hi guys, unrelated to cap rates. If I use my RRSPs for down payment as a first-time home buyer, will that amount be calculated in my debt ratio when qualifying? Can it be partly be used for closing costs?" So, great question. No, it is not calculated as a debt in your in your like qualification requirements. And can it be partly be used for closing costs? Yes. So you can use essentially the rule behind it's kind of gray, which people don't really know, but like the legislation states you have to purchase a property within a certain period of time after you pull the funds out. So as long as you purchase a property within a certain period of time after you pull the funds out, it doesn't say you have to specifically use the funds to purchase the property. It says you need to purchase the property within a certain time after you pull the funds from your account. So, there are people who sometimes pull the funds out but already have the down payment and then use those funds for investments and obviously to pay it back over a certain period of time. But you have to purchase the property within a certain time after you pull the funds out of your account. So you can use those funds for down payment, closing costs, land transfer tax, whatever you need to close on the property. And it doesn't go into your overall debt servicing obligations when you're looking at purchasing a home as a first-time home buyer.
Yeah.
Little tidbit of information.
And up to $35,000 from your RSPs can be used per borrower. So if there's a husband and wife on the application, you guys can both pull out $35,000 per borrower. So
yeah, so something to keep in mind is once our clients, I'd say 90% of our clients don't use that as a solution for the down payment. The majority of our clients either have a saved down payment or the bank of mom and dad usually shows up from the baby boomer side of things. Mm-hmm. But if you did or were going to use that, I would highly recommend assessing your payment on that with your mortgage. Something to keep in mind that a lot of brokers skip over is the fact that you need to pay it back. So if you have a mortgage payment that you're maxing out your qualification at and you have to pay back your RSPs over a certain period of time, you need to make sure that you're going to be able to float that payment and your carrying costs for your home and the regular monthly payments that you need to make in your RSP. So,
and that part is not taken into consideration when we do our debt obligations.
That's correct.
We don't automatically qualify you based on saying you can afford to pay your mortgage and pay back your RSP. So that's something that you have to do on your side to make sure you have the appropriate amount of funds and reserve capital set aside.
Yeah, something to keep in mind. But, getting into a property obviously isn't the easiest thing in the world, especially at the moment since house prices are rising and the barrier to enter the market is increasing. But there are a handful of government incentives that are given to you or offered at the moment to help people get into the market. We actually just dropped a Mortgage Minute we filmed today that'll be releasing, I guess, next month about Cmhc financing. If anybody doesn't know, Cmhc financing is mortgage default insurance. This default insurance is mandated by the government for 20% or less down payment. You need to pay this insurance. The insurance is scaled based off down payment. So if you put 5% down, essentially it's a 4% premium, leaving you with a 1% equity position in a property. We get people every single week reaching out to us saying, if I buy an owner-occupied property with 5% down, can I burn the property? Really good thing to keep in mind is if you do that, which it is possible to do, if you do that though, you essentially have a 1% equity stake in the property when you take possession. To be able to refinance a property, you need to, at the maximum amount a lender will be able to do is 80% loan to value. So you need to create 19% in equity in the property, and then you need to create another whatever percent you want to take out of the property in addition to the 19%. So to make it worth your while, you're probably seeing about a 30 to 40% increase in value in a very short period of time to be able to make it worth your while to do that. So when you are looking to get into a property or your first property and you want to do a BRRRR strategy, it really just, it makes sense to crunch those numbers and understand what that premium does to your overall qualification and how it's going to affect you moving forward with your strategy.
Mm-hmm. One other question here. My son plans to buy a primary home, but he's a student. Can the parents co-sign for the mortgage? Yep. So co-signers can be anyone who's an immediate family member. So we're talking sibling, parent, grandparents. Lenders and insurance company get a little timid when we start adding in cousins and second cousins type stuff. They do prefer it to be very immediate. But yep, parents can come on and co-sign. Basically on that application, we would use your employment and liabilities to help with the mortgage application. And as the parents and as co-signers, you would assume the liability and responsibility for that mortgage as well too. So just remember that as a co-signer, it does affect your ability to apply for another mortgage moving forward. It's on a different application.
Yeah, we actually don't need to deal with a whole lot of first-time home buyers, but when we do, obviously, we have solutions available to you guys to help you start your investment process and journey. Other than that, guys, I think that's kind of a wrap in regards to cap rate at the moment and what we were getting into and deep diving into. Again, we appreciate everybody joining on Instagram and on YouTube and on Facebook. If you guys do have any questions in regards to financing in general, feel free to reach out to Aaron and myself. We're always available, or just drop a comment in the chat below and we'll get back to you ASAP.
Yeah, guys. Yeah, absolutely. Again, just takeaways, just understanding how cap rate and how the hot market really affects your ability to purchase, especially on the commercial side. And like Josh said, if you guys have questions, if you're considering any purchases, feel free to run them by us. We can give you our thoughts and opinions and let you know what it's going to take a look like, projecting, ARV and how much equity could be available and what that strategy is going to look like. And, leave your comments and down below and feel free to reach out to us if you guys have questions.
Yeah. Thanks, guys.